Welcome back to another episode of the Tip Share. This week, what is the average profit margin for a restaurant? The restaurant industry has, by and large, low profit margins constrained by high capital, labor, and operational expenses. Yet, there is a wide range of profitability within the industry. From white tablecloth establishments with low single-digit profits to quick-service restaurants clearing over 10% if they're really on top of their game. Despite this variability, restaurant profit margins most commonly fall within 3 to 5% of annual revenue. An adequate profit margin is critical for the sustainability of a restaurant business, as it's from the profits, however slim the owner gets paid, and restaurants grow. If a restaurant business cannot maintain a sufficient profit level, it may not be worth the time and money the owners put into it, therefore shutting down completely. Conversely, a healthy and growing profit margin for a restaurant will safeguard the future of the business and provide funds for improvements or even expansion to multiple locations. Now, before we go any further, there's an important distinction to make between gross and net profit, two very different things. Let's start with gross profit. Operators calculate gross profit by taking the difference between sales and costs. If you sell a taco for $10 and it costs you $3 to make, your gross profit is then $7 on that $10 in sales. Quite simply, the gross profit formula is total sales minus cost of goods. Your gross profit margin is the profit on the item. In our taco example, $7 divided by the sale amount of $10 and then multiplied by 100 is going to give us 70%. That's our gross profit margin. Next, let's talk about net profit. Net profit is your gross profit minus all your additional expenses beyond your food costs. Think labor, overhead, maintenance on equipments, etc. To calculate net profit, you're going to use the following formula. Total food and beverage sales plus non-food and beverage earnings, things such as rentals or merchandise income, subtracted by your expenses. Now, the net profit margin is going to be our net profit, as we just calculated, divided by revenue multiplied by 100 to put it in that percentage. There are two ways to improve restaurants' profit margin. You can increase your sales or reduce your costs. In a well-managed restaurant, operators pursue both approaches simultaneously. Beginning with tactics to grow sales, a great point of leverage is the composition of the menu. The practice of strategically designing dishes for profitability is known as menu engineering and should be led by your chef with support from a manager who knows food costs really well. A well-designed menu will economize on ingredient costs while still building dishes that taste great and sell well. The key to proper menu engineering is accurate data and the knowledge of how to translate that data into your menu from a financial perspective. Utilizing an operational management system like RASI's is critical as it holds accurate product and menu data paired with the expert team to educate you in the knowledge of how to translate that data into your menu from a financial perspective. Additionally, menu specials are an underrated tool for the restaurateur. You can utilize menu specials to capitalize on vendor deals on ingredients. For example, let's say you get a great price on oysters for 1 week. How can you utilize that to your benefit? You can also design specials for quick cooking times, allowing you to serve more people in that same time period. Do keep in mind that you never want to dilute the value of your menu, and you should always keep customer value perception at the top of mind when creating specials. Beyond the makeup of your menu, an essential sales technique is to encourage the proper merchandising of menu items. This practice is only successful if your team understands the menu's margins to promote the items with the highest contributed margins. Additionally, servers can encourage the purchase of additional items per ticket. This is known as upselling and is most commonly practiced with sides, beverages, and desserts. Training staff to upsell with value can make a lasting improvement to your bottom line. A time-tested method of increasing the sales in your restaurant is to reduce the time the average party spends at a table, allowing for more table turnover. Table turnovers are defined as the number of times you can seat different parties at the same table throughout the day. For instance, you might seat 3 parties of 4 between the hours of 5 p.m. and 10 p.m., making for 3 total table turns. It's a subtle art to encourage diners to eat and exit at a reasonable pace without actively rushing them. You've probably already had specific servers who are better at this than others. You can try using POS data to evaluate your best table turner and have them train other servers on their techniques. Those were some simple areas to attack if you want to improve your profit by increasing revenue. Now, we mentioned before there were 2 ways to improve your profit. We're on the flip side now, reducing expenses. A significant component of expenses for any restaurant is the cost of goods sold, all the ingredients that go into your food and beverages. And the first step in controlling your COGS is streamlining your inventory. Food that sits on your shelf, potentially even spoiling before use, isn't contributing to your bottom line or your dishes. Track your ingredient usage, and based on those numbers, you're going to want to stock just enough inventory to meet your needs, plus a small margin of safety. Another quick way to reduce expenses is to track and measure kitchen waste. So once you have your inventory under control, this is the next thing you're going to want to tackle. You can ask your cooks and chefs to record when they throw away food, and additionally designate a receptacle just for food waste that can be weighed at the end of each day. Soon, you'll have the data to make changes in the kitchen based on how much waste is generated. An additional step in controlling food cost is to standardize portion size. Cooks and chefs should measure the amount of each major component of a dish to ensure that it meets the guidelines set by the chef. An 8-ounce steak dish should contain 8 ounces of meat, not sometimes 7, sometimes 10, etc. 8 ounces means 8 ounces. By regulating your portion sizes, you reduce overall ingredient consumption while increasing the predictability of your inventory needs. Many restaurateurs aren't aware that they could be substantially cutting their food costs by participating in a purchasing program. These programs, such as RASIs, leverage the buying power of multiple restaurants to negotiate ingredient pricing at better rates from vendors. These steps to limiting your COGS will make a substantial contribution to improving your profit margin and can boost your profits above levels of average restaurant profits discussed at the beginning. Additionally, purchasing programs can enable you to know that decisions affecting purchasing are carried through to your financial performance. A purchasing program is going to keep more money in your pocket versus the manufacturer. All 3 of these points are a win to join a purchasing program. Utilizing the right back-office software can be a considerable advantage when seeking to increase your restaurant's profitability. A solid restaurant accounting software solution should integrate with your point-of-sale system to contain the latest sales and performance data straight from the source. Next, it should position you to manage the financial metrics that matter most to your business through customizable dashboards. RASI meets and exceeds these requirements, integrating accounting, compliance, payroll, cash management, treasury solutions, and financial operating metrics all under one roof. Thousands of restaurant operators across the nation have made RASI their choice for restaurant management. When you sign up with RASI, a dedicated accounting team will onboard your management staff, configure the software to match your operational flows, and coach your team to properly use the software to set and meet financial goals. You can always contact us for a free demo of our software suite at rasiusa.com. That's it. That's this week's episode of the Tip Share. We hope you enjoyed, and as always, we'll see you next week.